Breaking news, 1,000 employees in the mortgage banking division at J.P. Morgan are hanging in the balance at this hour. Bloomberg reports that J.P. Morgan, the largest bank in the U.S., is preparing to lay off about 500 employees in its home lending business and reassign another 500. JPM is blaming slowing demand in the housing market due to the recent rise in mortgage rates. And how much have they risen? Well, according to Freddie Mac, the average 30-year fixed rate now stands at 5.78%. That is a 51% increase year over year. Alliant Credit Union is one of the largest top credit unions in the U.S. They have 600,000 members nationwide, $15 billion in assets under management. It is the largest credit union in Illinois and one of the top 5 in the USA, and they hunt for the best rates on all kinds of loans. Here in a Fox Business exclusive is the Alliant Credit Union president and CEO, Dennis Devine. Dennis, wow, you start to really see that this is hitting home when J.P. Morgan says 500 of you, we don't have work for you at this point. That must mean the mortgage world is drying up. What are you seeing on the ground?
Well, Liz, first of all, thanks for having me. Sure. And it's real. You see mortgage rates on a 30-year rate that's nearly twice what it was just a year ago. And so the opportunity to refinance is much less than it was. Home prices increase along with those rates, and you see a slowdown. Mortgage has always been a cyclical business, but it's a tough one for that very real human outcome.
Well, you do mortgages, and you also, for your 600,000 clients, hope to find the best possible rates, not just for mortgages, but also for car loans and credit card loans, et cetera. Tell me what you are finding and how much harder is it to find really low rates at this point?
Well, we have at Alliant a unique model, which is we are a national digital institution. And so we have the benefit of among the best cost structures in the industry. One other factor you see going on in financial services right now is bank branches are closing at a record clip. Folks just visit them a lot less frequently than they used to. And so a digital institution is able to take the benefit of that cost structure and give it back to customers. And so that's exactly what we see occurring in the market right now, which is institutions that are digitally focused, that are more focused on delivering digital experiences of value to their customers are able to do so right now in ways that are a bit different.
Well,
on lending and savings.
Yeah, well, you've got scale. What are you seeing? What's the lowest you can get as an average 30-year fixed for your Alliant customers?
Well, you'll find that there's a very competitive market across the 30-year fixed space. And so you'll find with Alliant a bit better than those rates that you just quoted on a national basis. But the thing that you look to in addition is some institutions will work with their customers to be able to structure loans in different ways. Fixed for a period of time and then variable after that, you'll hear. Yeah. Now, much different underwriting criteria than would have existed a decade ago before the Great Recession. But there's opportunities to work thoughtfully with your financial institution to be able to find ways, depending on your needs and your time horizons, to be able to structure your debt that way.
What about auto loans? Are you seeing any slowdown in auto loans at this point?
We are, of course, and the industry is. You see, even in the most recent monthly numbers, decline in auto sales, and that's having an impact on the industry broadly. Rates are going up, and cost of fuel, of course, is a factor in how individuals are thinking about it. Not to mention the supply chain has really reduced the volume of cars, and therefore the prices.
We've just seen Winnebago come in with very strong earnings numbers. You guys do RV loans. You also, as I understand it, do Tesla loans, correct? EV loans? Yep. Tell me about the market for that at the moment.
Well, the RV market really has been hot through the pandemic and then after. It's an outstanding opportunity for many to find an ability to travel within the U.S. And so RV dealers have seen record sales. That's an important asset class for Alliant, and we've been right there along with them. EVs, of course, have seen growth. We were an early Tesla lender, and you've seen continued growth in that manufacturer as well as others across the industry.
Yeah, I just want to flag our viewers. The Dow, S&P, NASDAQ, and Russell and transports have all turned negative while we're speaking. I'm not blaming you, Dennis. Talk about the silver lining here. Higher rates mean savers are finally getting a better rate of return. But is it where you'd like to see it and where you think it should be?
Liz, I'm surprised that there's not more attention on this topic right now. because there's no doubt that as interest rates are increasing on each of the loan categories we discussed, consumers have to plan, but the savings rates have the ability to be better than they've ever been. Now, not every financial institution is doing that just yet and passing those rates on. But if you do a bit of shopping, you're going to find that there are many institutions, especially digital institutions, that are increasing savings rates and CD rates rapidly.
What are they standing at? Give me a...
Yeah, 1% for a standard money market savings rate is easy, very common to find at this point. I think you'll find 2% on CDs with terms as short as 18 months. And so that's a vast increase on what you would have seen just a few months ago. And it's a silver lining to this, as folks exited the recession on average with more savings than ever. Being planful now and taking advantage of those higher rates will help.
Dennis, thank you. And you're doing great work for your customers. And we appreciate you opening a window into your business.
Thank you.
Dennis Devine.